You're in the Business Insurance Zone with me, Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. This week on The Biz, the Insurance Company Financial Review, and on today's show, the Company Investment Portfolio with special co-host, Certified Financial Planner and CPA, Ken Davis.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I am your host, Steve Savant, and we're broadcasting to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me, day three, Mr. CLU, CHFC, CFP, and CPA, my friend and your colleague. Actually, I call him the liaison between our industry and the fiduciary market, Ken Davis.
Stephen, good to see you.
Do you like to be the diplomat? I've so dubbed you.
I am the diplomat,
okay.
yes.
I so dubbed you. Well, if you missed our show, I have to tell you, you need to go out and watch this in succession. It really helps.
Yeah.
We're walking through the balance sheet issues of carriers, the Blue Book, the Convention Blank, and we're doing it using one of the greatest software pieces that has ever been put out by Ebix called Vital Signs. I've been using it for over 2 decades. I cannot tell you how many cases I've won just by having intel that nobody else brought to the table. Ken, today we're going to talk about up our game now. We talked about some of the basic balance sheet items yesterday, just kind of introduction. And remember, Vital Signs includes this glossary, which is to die for. This will help you. Every line that you go through your balance sheet has the definition. Anytime somebody says, what does that mean? I just cut and paste, put their language, their nomenclature in. I never pontificate myself on this, and it's really unbelievable, and it'll help you actually in your learning curve. It really helped me understand this.
Well, what's interesting is you don't have to pontificate on it because the people reading it that are asking for it understand it. If the CPA is saying, well, tell me about this, what does that mean? Well, you can just give them the verbiage and they go, oh, okay. You don't have to even understand it to look like a top professional. You just answer their questions, give them the information so they can help the client make good decisions.
Wow, Ken, I'm a top professional only maybe by image.
Well, you're giving information. You're serving the client.
Let's just talk about this for a second. We're going to go through some of the asset quality analysis, okay? Now, give me the difference between investment grade and non-investment grade because they're classified.
Well, yeah, and it's a little bit different. Typically in the investment world, if it's a triple B plus type bond or stock, you're okay, and that's investment grade. They don't rank them that way. They have class 1 through 6, and in the world of insurance, class 1 and 2 is considered investment grade. Everything else is non-investment grade.
Well, in that investment grade, I'm looking at most people. When you're looking at non-investment grade bonds, and you're in the class 3 through 6, of course you don't want to be in 6 because that's in or near default.
Right.
But when you're looking at this, most of them have a pretty good amount of money of their investments in the investment grade area. You don't get to see a lot of people in the non-investment grade.
No, and I think that's one of the big changes to the rating process is prior to the Drexel Burnham and Executive Life situation where it all fell apart. An A+ rated company and a well known bond company had major troubles, and it was all over junk bonds. And the rating services, I don't think at that time paid enough attention to the quality of the bonds. When I looked at Executive Life, I said, there's something wrong here. This just looks too good to be true. And it was about 50% in junk bonds. And even back then, even the investment people said, oh, that's no big deal because historically you've only had like 0.5% or 1% default if you manage your junk bonds properly. Well, they were issuing brand new bonds to the tech companies that had no bricks and mortar and no way to recover. And so it was a different paradigm, yet they're using historical data to support their situation. So, looking at the quality of the bonds, looking at the quality of the assets is important. And whereby, like 2008, the rating services still had high ratings for some companies, even though they had high percentages in mortgages. And that might have been correct, but it made me nervous, so I stayed away from them.
And that was because you actually knew how to read this. See, this is why I'm trying to get to this. Like, sometimes you have to look at the heads up. As I said Monday, we look at the ratings watch service. That's every 30 days. Could be good, it could be bad. We're tracking it. But when I'm looking at non-investment grade as it relates to surplus and MVR, I'm thinking, well, the third class is not like it's bad bonds, but it's not investment grade. But when I get down to class 6, which is in or near default, and if I saw class 6 bonds equal to or greater than a carrier surplus and AVR, I'd be in panic mode.
Well, and what's interesting is on this report, a couple lines down, non-performing bonds. While non-performing bonds as a ratio to total bonds is only 0.1%, and you go, ho hum, who cares?
Right.
But the next line is really kind of telling.
Right, exactly.
Non-performing bonds divided by surplus and AVR is 0.7. So because of the leverage that all banks and insurance companies, and I'm not picking any particular company, they all have the same issue. They are highly leveraged financial assets, and so a 0.1% equates to 0.7% of surplus. So what does that tell you? Well, for every percent, I get 7%. Every 0.1%, I get 0.7% in eating up surplus and reserve. So because they're highly leveraged, even relatively small percentages in default or problems can have a very substantial impact on the strength of the company.
No doubt about it. And we look at this. This is why, again, we're looking at things like this, especially as we get up to larger cases, the CFOs of businesses, the CPAs of the client, the attorneys for their estate, they want to see things like this.
Well, and what's interesting is some of the better paying annuity companies, when you look at the ratings, they're a triple B plus, okay? Or B plus on AM Best or whatever, and you say, oh, I don't want to deal with them. Well, what's interesting is sometimes you look at the surplus of those companies and they're huge. And so why are they so lowly rated? Well, the ratings companies don't like that all they do is sell annuities and aren't well diversified. I look at that and say, I can make that exception. I feel good about that.
If you took the balance sheet as a standalone issue on many of these annuities and you took it to any CPA, they're going to be okay with this. Diversity in business, well, maybe that's their niche market. Maybe that's where they want to live. When we come back from the break, we're going to continue talking about the company investment portfolio with co-host Ken Davis. And don't forget to test drive Vital Signs absolutely free by going out to their site, www.vitalsalesuite.com/logins/the biz.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Ebix's Smart Office solution is used by thousands of professionals worldwide. Focused 100% on serving our industry, our proven technology has made us the #1 provider of CRM, practice management, and agency management solutions. Smart Office features include anywhere, anytime web-based capability, on-the-go mobile access, industry-specific functionality, integrations with key industry partners, investment data downloads, robust integrations with other Ebix products, and a high-powered email marketing capability through Constant Contact. Smart Office provides a complete wealth management platform that gives you the tools and flexibility to support your practice today, and an integrated advisor workstation designed to extend your solution as your practice grows. Make Smart Office the center of your practice. Get Smart Office today.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Ken Davis. And remember, you can order today's materials at thebiz.tv. And while you're out there, click on the background technician icon on the Biz blog right on the top part. And you can order your 30-day free trial offer for the best needs analysis and education materials that address almost every financial planning scenario. I highly recommend that you go out and take the test drive. If you're like me, I've been using these guys for over 20 years. Backroom Technician's huge. I've made money on that time and time again. The subscription's nothing. And just a heads up, well, it's not nothing. You have to actually pay for it. But just a heads up, before I say nothing, everybody say, hey, they're giving it away free. Yeah, for 30 days we are. And before we move forward with any of the ideas on the show, always consult your tax advisor or legal counsel, as well as your broker-dealer compliance officer if you're FINRA licensed. And we're making it our business to know some of the portfolio investment postures. And I just want to bring up and touch on this because I want to let Ken loose on the bond portfolio. Clients, these carriers have non-performing mortgages in real estate, but as a percentage of surplus and MVR, most of these people, it's so small. So I'm not going to manage it like I used to manage it in the early 90s because it was a concern. Also, you want to look at all non-performing assets, all in, real estate, bonds, whatever you have. I want to see all of it, mortgages, and I want to calculate that against my surplus and AVR because that's kind of a telling place. Man, if my total junk bond, my total bad mortgages, my total non-investment grade, this is what I'm looking for to see, is my surplus going to be able to hang on if the worst scenario occurs?
That's right. And as we saw in the late 80s, early 90s, as good as the rating services are, things do change. And they hadn't changed their paradigm, and they weren't looking at the quality of bonds in the portfolio as heavily as they should have. After that mess with the Drexel Burnham thing and Executive Life blew up, they changed their strategies and do a much, much better job at that. But who knows? What's the next thing that comes down the pike that they haven't prepared for? We can look at it and we can be a little bit quicker. They have to change company policy and process and everything else. We can look at it and say, hey, it's 2008, credit quality is a big deal, mortgages are in default, there's problems in the industry. This may be a highly rated company, but I'm staying away from anybody that has any substantial mortgages in the portfolio.
Ken, let's talk about bond portfolio. I mean, you're looking at not only the quality of the bond, but you make a big deal on the maturity of the bond, and especially if we ever get out of this low interest rate market.
Yeah, one of the things I'm looking at is I've been looking at, my anticipation is that, and it's just a guess on my part, that interest rates and inflation are going to rise at some point in time. We are at historical lows. We have a massive amount of debt. Historically, we've seen the government monetize the debt, print money to pay off their debts and cause inflation as a result of pumping up the money supply. A current situation with the Fed is heavy infusion of cash and liquidity. So if that happens, I want bonds. I've got clients in annuities that have 8-year, 10-year, 12-year, 14-year penalty periods of time. I'm going to feel pretty crummy if 7 years from now interest rates are through the roof and the client's stuck with low interest rates. So one of the things I'm looking at is if I've got a floating rate bond or a MYGA that ends after 5 years and then floats, for instance, the weighted average maturity of the bond. If I've got one company that's at 5, they may not be making high interest rates, they may not be paying the highest interest in the market right now, but boy, are they ready when inflation interests take off to reinvest at higher interest rates and thereby credit higher interest rates. And in the index market, maybe have more cash from the earnings to go out and buy the options to give higher cap rates. I'm not saying they're required to or it's guaranteed, but they have the cash to do it. And so I want to deal with companies that have a little shorter duration. That's my own bias.
If rates do start going up, I've noticed that it may actually impact certain carriers harder than other carriers. I think it would be quicker, I'm guessing here, it would be quicker for universal life products, indexed, variable, current assumption, to move a little quicker in the bond if rates go up than it would maybe for whole life because there are a lot more long-term treasuries involved.
Well, there was days when we saw interest rates dropping that we paid a lot of attention to the policies of companies and how they credited interest. There is the whole portfolio, which applies to everything, and that's just kind of a one-size-fits-all moo-moo kind of thing, right? Then there were others that would break it up and say, okay, we're going to allocate this to universal life, this is going to go to whole life, this is going to go for annuities and whatever, and they actually managed the detail and back their promises to pay and interest rates to specific parts of the portfolio. I mean, now you're micromanaging again to a great deal of detail. I'm saying as a start, look at the average duration and how flexible they are, that as those bonds are maturing, they can reinvest at higher interest rates. Whereas if you got a 20-year average duration, boy, I'd stay away from that kind of thing. I would have a problem with that.
I'm just looking at this example, as the carrier's not really important here, that they have 16% in 1 year or less, so that's totally cash liquid. You're looking at another 28% for 1 to 5 years, 22% from 5 to 10, 12% from 10 to 12, and everything 20% of 20-year bonds on out.
Yeah, it's a 9.7-year duration. I know in investment portfolios, I don't manage them anymore and I don't give advice on those, but if I were still doing that, I'd be concerned. I would be looking more at shorter durations of maybe 5 to 7 years or less.
Now, when you think about the annuity rate, the lead annuity out on the streets right around 3% for 5 years. I don't know if you'd want to go out any farther in this market. 3% I could live with. If you start trying to get down 3.25 for 4 more years, 25, 30 basis points, is that worth doing?
Yeah, and the temptation for us as advisors is to go for the maximum yield so it's easy to sell, but we may be setting ourselves up for failure.
I think laddering is going to see its day right now. We're going to start seeing the way to position annuities because of these issues that we're talking about on the balance sheet on the bond holdings of carriers. Unbelievable. Well, that's our show for today. Remember, you can follow me on Twitter, Facebook, LinkedIn, or email me, steve@thebiz.tv. That's the Buzz on the Biz for today. You've been in the zone, the business insurance zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.